welcome to the deep dive. Think about this for a second. Experts are predicting nearly 39% annual growth for AI in financial services. That's huge.
It really is. And you pair that with the digital lending market itself. What's the projection? Something like $800 billion by 2029.
Exactly, barreling towards it. Okay, so let's unpack why those massive numbers matter for what we're digging into today.
It's that intersection, isn't it? This explosion of digital tech in, borrowing and lending, meeting the power of AI. It's not just faster old ways, it's changing how credit decisions get made fundamentally.
Absolutely, and that brings us right to our focus. Upstart Holdings, Inc., ticker UPST. This is a company saying, hey, AI can make lending smarter, more accessible, connecting people who need loans with banks that want good borrowers.
Right.
We're looking closely at Upstart as of May 7th, 2025, right after their latest earnings came out. And our mission today is really to get under the skin of this business. How does it work? Its financial health? Where does it sit in the market?
What are the risks?
What are the risks, yeah. And what's the potential here for, say, a value investor? We're also keeping an eye on the bigger picture, those 2025 U.S. tariffs everyone's talking about. Quick snapshot. Upstart closed yesterday at $51.40.
The core question, I think, for you listening is, can Upstart's AI approach truly carve out a lasting, profitable spot in this, let's face it, very established industry? We need to look past the buzzwords, really analyze the engine.
Totally agree. So for you, our listener, what can you expect? We're going to break down Upstart piece by piece, pull out the key insights from our research, and give you a clear picture of what makes them tick and maybe what could make them stumble. No super complex jargon, just the info you need. Let's jump in. Chapter 1, business understanding. So in simple terms, what does Upstart actually do?
Okay, so at its heart, Upstart runs this AI-powered lending marketplace. Think of it like a digital platform connecting borrowers with banks and credit unions. But the key difference, the thing that sets them apart, is how deeply they integrate AI and machine learning to figure out who's creditworthy. They look beyond just the traditional FICO score.
Right, the FICO score isn't the whole story.
Exactly. Their algorithms crunch a much wider set of data things like, your education, your job history, maybe even what you studied. The idea is to get a more nuanced, they'd argue, a more accurate picture of risk.
So it's like looking at the whole person, not just a number. And this is all cloud-based, yeah. I also saw something about powered by Upstart. What's that about?
Yeah, totally cloud-based. Gives them flexibility, efficiency. Powered by Upstart is basically their software as a service, their SaaS offering. Banks and credit unions can kind of plug Upstart's AI brain right into their own lending systems.
Ah, okay, so the banks use Upstart's tech.
Right. It helps them automate, maybe cut costs, reach customers they might miss with old scoring methods. And it's worth mentioning a huge chunk, like over 90% of the loans going through their platform are fully automated. Very little human touch needed.
Wow, over 90% automation. That sounds like a massive efficiency play.
Mm.
Now, looking at what they offer, personal loans are the main thing, but they've branched out, haven't they?
They have. Personal loans are still core, think $1,000 to $50,000, 3 or 5 year terms for things like debt consolidation, home improvements, whatever. But yeah, they've moved strategically. They bought Prodigy Software, which got them into auto loans, both retail financing at dealerships and refinancing.
Okay, auto loans too.
And more recently, they've stepped into home equity lines of credit QLOCs. Plus, they even offer these small dollar relief loans for shorter term needs. And a big draw for borrowers is checking their rate online quickly, without a hard credit hit initially, and then getting funds fast if approved.
Got it. So they're connecting borrowers and lenders across different loan types. How does Upstart actually make money here? What are the main revenue streams?
Okay, so primarily they earn fees from their partner banks and credit unions. That falls under revenue from fees, net. These are things like platform fees or referral fees when a loan gets originated through them, plus servicing fees for managing the loan over time. That's the biggest piece of the pie right now.
Okay, fees are number one.
But we're also seeing this growing piece called net interest income loss. This happens when Upstart actually holds loans on its own books.
Ah, so they take on the risk themselves sometimes.
Exactly. They might do it for R&D, testing models, or maybe when the funding market gets tight. But when they hold the loan, they take on the credit risk the borrower defaults, and also interest rate risk.
Right, that changes the game a bit, acting more like a traditional lender. What do the recent numbers show for these revenue streams?
Well, in Q1 2025, total revenue was $213 million. The bulk of that, $185 million, came from fees, but $27.9 million was from that net interest income.
Okay, so not insignificant.
No, And looking at their guidance for the full year 2025, they're forecasting about $1.01 billion total revenue, around $920 million from fees, and maybe $90 million from net interest income. So fees are still king, but the loan holding part is definitely becoming more relevant financially.
Got it. So they're playing this huge digital lending space. AI and finance is booming. How are they positioned? What's the total market they're chasing?
It's massive. The U.S. digital lending market alone was, what, $457 billion in 2024, projected over $800 billion by 2029. Global is even bigger. And yeah, AI and finance is just exploding.
Right.
Upstart reckons their total addressable market TAM across personal, auto, home, and small business loans is in the trillions. They've shown strong volume in personal loans, sometimes outpacing competitors, but it's super competitive.
Yeah,
You've got the big traditional banks who are getting savvier with digital and AI. Then you've got other fintech, SoFi, Lending Club, Affirm's even a competitor in business lending. So yeah, plenty of competition.
Huge market, but crowded. So what about a competitive advantage, an economic moat? Can Upstart build something lasting to fend off these rivals?
That's the million-dollar question, isn't it? For long-term investors, their potential advantages come from a few places. First, obviously, is their proprietary AI tech and the data behind it. They talk about over 10.5 million repayments, more than 1,000 variables crunched.
Okay.
They argued this lets them approve more creditworthy people, maybe people FICO misses, including, they claim, more Black and Hispanic applicants, and offer lower APRs. And the model learns, right? More data, better model, attracts more users, generates more data. A potential network effect there.
That sounds powerful, the learning loop.
It could be. But, how defensible is that AI moat long term? That's debatable. Competitors are pouring money into AI, too. And the black box nature of AI, well, that brings regulatory scrutiny. Remember that report about approval disparities for Black applicants? Upstart disagreed with the methodology, but it highlights the challenge.
Yeah, that's a really critical point. The AI is key, but maybe not an impenetrable wall. What other potential moats are there?
Oh, there's the platform network effect. More borrowers attract more lenders mean better options, which attract more borrowers, the two-sided market dynamic.
Right.
They have over 100 banks and credit unions now, plus big funding deals like that $1.2 billion Fortress agreement. That helps. But it hinges on loan quality and funding always being there.
Sure.
Then maybe some switching costs for banks using that powered by Upstart software if it gets deeply embedded. And finally, maybe brand recognition as an AI lender, plus that high automation over 90% potentially leading to lower costs and better rates.
Okay, so if you had to sum it up, how strong is Upstart's moat right now? Is it solid or still kind of under construction?
I'd say it's probably nascent to moderate. The AI and network effects are promising, definitely, but their durability through different economic cycles and against tough competition, that's not fully proven yet. The rough patch in 2022, 2023 showed some vulnerabilities.
Okay, that makes sense. Let's shift gears and talk about the leadership. Chapter 2. Management evaluation. Who's running the show at Upstart?
The CEO is Dave Girard. He's a co-founder, came from Google Enterprise, so strong tech background. And importantly, he owns a pretty significant chunk of the company himself, around 11.3%. That tends to align his interests with shareholders.
Yeah, skin in the game. Who else is key?
You've got Sanjay Datta as the CFO, and Paul Gu, another co-founder, is the chief product officer. There are others too, of course, but those are some central figures. Average tenure for management is around 5.6 years. Board is similar.
Okay, and what's their track record like? How have they navigated things so far?
Well, they've definitely seen some action. They took the company public, rode that wave of massive growth, then had to manage the downturn in 2022, 2023. Recently, the focus has been recovery and diversification. Girard talks a lot about efficiency, diversifying funding sources like that Fortress deal, pushing into new products like AI losses and auto, and aiming for GAAP profitability in the second half of this year, 2025. His style is apparently quite focused on speed. Management by exception.
Efficiency and diversification seem like smart moves, given the volatility. Now, I did notice quite a bit of insider selling. How should we read that?
Yeah, value investors always look at that. Over the last year, insiders have sold a net total of over 1 million shares. Now, some of that might be pre-planned, 10b5-1 plans. People sell for lots of reasons.
Sure, personal financial planning, taxes.
Exactly. But still, a high volume of net selling can be a yellow flag. It might suggest insiders feel the stock is fairly valued or maybe even richly valued. Generally, investors prefer seeing insider buying as a sign of confidence.
That makes sense. Okay, so how is this team allocating Upstart's capital? Where are they putting the money?
seems like a few key areas. Number one is investing back into the AI models, and tech R&D is crucial. They're also using capital to fund some loans directly on their balance sheet for R&D, liquidity, launching new products. Remember, about 10% of 2024's originations were held?
Right.
Then there's product expansion pushing into auto, HLOCs, small dollar loans, plus strategic partnerships and diversifying funding like the Castle Lake and Fortress deals. They don't pay dividends, they're reinvesting for growth.
Any share buybacks?
They've mentioned it as a possibility, but nothing concrete detailed. They do have that $500 million at the market or ATM equity program, meaning they can sell shares into the market gradually for general corporate needs. And a big part of capital allocation is just managing that balance sheet risk, especially the loans they hold, which get marked to market.
Okay, managing that risk is key. All right, let's get into the nitty-gritty. Chapter 3. Financial health. We've touched on revenue, but let's really break down the financials. How's that revenue growth looked over time?
Well, like we said, it was explosive post-IPO. Then wham, a big contraction in 22 and 23 with the rate hikes and market shifts.
The downturn hit them hard.
Yeah. But 2024 saw recovery, and Q1 2025 was strong, 67% year-over-year growth. And their forecast for full year 2025 is pretty bullish, around 59% growth to hit that $1.01 billion mark. So, strong rebound projected, but you just can't forget how sensitive they are to the economy.
That volatility is definitely the headline. What about profitability? Because growth is great, but you need profits eventually.
Absolutely. And profitability's been, well, a roller coaster, too. They were GAAP profitable back in 2021, then big losses in 22 and 23.
Ouch.
Yeah, 2024 loss was smaller, but Q1 2025 was a big improvement, almost break even on a GAAP net basis. And the big news is their guidance. They expect positive GAAP net income in the second half of 2025 and for the full year. That's a huge milestone if they hit it.
Definitely. What about other metrics like contribution margin or adjusted EBITDA?
Contribution margin, that's revenue minus the direct variable costs of loans, actually dipped a bit in Q1 25 year over year from 59% down to 55%. Something to watch. But adjusted EBITDA, which is a non-GAAP measure, looked much better in Q1, and they're guiding to a healthy margin around 19% for the full year 2025.
Okay, so the trend is towards profitability. Definitely encouraging, but maybe some bumps in the road still and dependent on hitting those forecasts. Let's peek at the balance sheet, key assets and liabilities.
As of end of Q1 25, they had decent cash, though down a bit from year-end. A good chunk of restricted cash, too, likely tied to securitizations. The big asset, of course, is loans held at fair value over $800 million worth.
And on the other side, liabilities.
Liabilities were around $1.6 billion total. Borrowings are the main thing, mostly warehouse lines and securitization notes. Their debt-to-equity ratio is roughly 2.4, maybe a touch lower depending on the source, like Y-Charts has it at 2.2, so definitely using leverage. Working capital seems okay based on the current ratio.
Okay, so they carry a fair bit of debt. What about cash flow? Are they generating cash from operations?
That's fluctuated too. Negative operating cash flow in 22 and 23. Positive in 2024, but then Q1 25 dipped back into negative territory slightly.
Okay.
Investing cash flow is mostly buying and selling loans. Financing cash flow reflects their debt management, equity issuance, securitization stuff. Free cash flow, the cash left after CapEx, has mirrored operating cash flow, mostly negative recently except for 2024. Consistent positive free cash flow is really what you want to see long term.
Makes sense.
Yeah.
So summing up the financial health based on ratios like ROIC or profit margins.
Well, return on invested capital, ROIC, and return on equity, ROE, are currently negative across most sources. That just reflects the recent net losses. These ratios tell you how well a company uses its capital to make profit, so negative isn't good, obviously.
But improving, potentially.
Exactly. The trend in profit margins is improving, and the guidance is for positive GAAP net income for the full year. We also need to watch operating metrics. Transaction volume is way up, conversion rates are improving significantly, and that high automation level is key for efficiency. And crucially, credit quality. Management sounded positive in Q1, but you have to watch delinquency trends and remember some past vintages underperformed.
Okay, so a complex financial picture, high growth potential, a path back to profitability laid out, but definite volatility in the past and a reliance on borrowing. We've covered a lot on the business, management, and financials. Let's take a quick break, and when we come back, we'll dive into market sentiment and the risks. Stay with us. Welcome back to The Deep Dive. We've just unpacked Upstart's business, leadership, and financials. Now let's get into Chapter 4, Market Sentiment. How are investors and analysts feeling about Upstart right now?
It feels pretty mixed, Maybe leaning cautious. Zacks has them at a #3hold. Earlier analysis showed a lot of holds and sells, and the analyst price targets, they're all over the place.
Really? Like how wide a range?
Super wide. Average might be around $70, but you see targets from like $9 bucks all the way up to over $150. That kind of spread just screams uncertainty and disagreement about where this thing is headed.
Wow, $9, $150. That tells you a lot right there. Why such different views?
It probably comes down to how much weight different analysts put on the growth story versus the AI defensibility versus all those macro risks we talked about. And it's telling that even after Q1 earnings beat expectations, the stock dropped, what, 17%?
Yeah, that was surprising.
Could be anything. The contribution margin miss, the Q2 gap loss guidance, even with the full year profit outlook, maybe just profit taking, shows you how complex sentiment is. Good news doesn't always mean the stock goes up.
Very true. Expectations matter. Okay, so analysts are divided. What about the short sellers? Are people betting heavily against Upstart?
Oh yeah, short interest is high. Really high. A big percentage of the float is short right now, something like 28%.
Wow, 28%.
Yeah. It signals strong bearish sentiment from a chunk of the market. They think the price is going down. The days to cover is also pretty high, around 4.7, 4.8 days. That means it could get volatile if there's good news and shorts have to scramble to buy back shares, the potential short squeeze. But fundamentally, it shows a lot of skepticism about the business, the valuation, or the risks. And there's considerable off-exchange shorting, too.
A high short interest definitely flags significant doubt.
Yeah.
Who's on the other side then? The long-term holders, the institutions? Let's talk institutional ownership.
Institutions hold a big piece, yeah. The majority, actually. Over 600 institutions own the stock as of early May. Big names, Vanguard, BlackRock, D.E. Shaw, Morgan Stanley, Goldman Sachs. They hold around 70% of the shares.
So the big money is definitely involved.
Which can provide some stability, but it also means if one of those giants decides to sell a big block, it can really move the price.
Good point. Now what about the ultimate insiders, management? What's their recent trading been like?
Well, like we mentioned, the net trend over the past year has been selling. Over 1.1 million shares sold net. You see some specific sales under those 10b5-1 plans, like from the chief legal officer, Scott Darling. You see option exercises from Paul Gu, but overall, more selling than buying.
And from a value perspective?
Caution, maybe. It doesn't prove anything negative people sell for all sorts of reasons. But investors usually feel better seeing insiders putting their own money in, not taking it out.
Right. Actions speak louder sometimes. Now, Chapter 5 was ownership structure, but it sounds like we've covered the key parts, institutional and insider holdings, pretty well already.
Yeah, I think we have a good handle on who owns the company between those two groups.
Okay, great. Let's move to the crucial part. What could go wrong? Chapter 6 is risk assessment. Think SWOT analysis, but let's focus hard on the risks here. What are the big macroeconomic threats hanging over Upstart?
Macro is huge for them. We saw how sensitive they are to interest rates in 22-23. Future Fed moves, big question mark. Inflation is another one. Erodes spending power, could push up defaults. And just a general economic slowdown or recession. That means job losses, less confidence, more defaults, probably tighter funding for Upstart too. That 2022-2023 period was a real stress test, showed their vulnerability.
Absolutely. And we have to talk about those potential 2025 U.S. tariffs. How could they impact Upstart and fintech generally?
Yeah, the tariffs are a wild card. Generally, they can slow the economy, raise costs, reduce demand. For fintechs like Upstart, that could mean higher interest rates overall, less demand for loans if people are feeling squeezed, more defaults.
Makes sense.
And funding could get tighter if investors get spooked. Specifically for Upstart, tariffs could mess with their AI models if borrower behavior changes drastically, and the tariffs might hit their target customer segments harder, increasing credit risk. It basically adds another layer of potential pressure on top of existing macro worries.
So, potential amplifier of existing risks. What about risks specific to Upstart's own business model?
Several key ones there. First, the AI models themselves. Are they truly effective long term? What about errors, biases, performance, and new economic weather? Regulators want transparency, which is tough with complex AI. And we know some older loan vintages underperformed. It's a constant question mark.
The core tech has to work reliably.
Exactly. Then there's funding. They need those third-party banks, credit unions, investors to buy the loans. If that funding gets expensive or dries up, like it did partially in 2022, their growth engine stalls. Diversification helps, like the Fortress deal, but it's still a dependency.
Funding is critical.
And competition. Never forget competition. Traditional banks are upping their game. Other fintechs are innovating. It's a constant battle.
And what about the regulatory side? Fair lending, AI bias.
Oh, that's a minefield. Fair lending rules and AI bias are under a huge microscope. That independent report finding disparities for Black applicants, big deal, even with Upstart's disagreement on the method. Plus, the rules for AI in finance are still being written. Creates uncertainty, could mean higher compliance costs. Think about data privacy, too. CCPA, FCRA, massive amounts of sensitive data. And since they partner with banks, the banks are also on the hook for overseeing Upstart. It's complex.
Definitely sounds like a tightrope walk with regulation. Okay, we have covered an enormous amount. Let's try to wrap this up in Chapter 7, our brief conclusion.
Yeah, Upstart is really a fascinating story, isn't it? Using AI to shake up lending, they've shown impressive growth potential, and they've laid out this plan to get back to profitability.
Yeah.
But yeah, huge risks too. Macroeconomic swings, intense competition, the regulatory spotlight. Their sensitivity to the economy is clear, and that economic moat, while potentially there with the AI, is still solidifying, maybe?
So for you listening, the learner, looking at Upstart means weighing that exciting potential against some very real, significant risks. It's complex.
It really is. And that actually brings us to something potentially pivotal, an event coming up very soon that could really shape their future, something we haven't quite hit on yet.
Ooh, okay, you got my attention. What is it?
It's their upcoming Upstart AI Day. It's scheduled for May 14th, 2025. What they reveal, their tech roadmap, new AI stuff, strategic vision that could seriously change the whole investment picture we've been discussing today.
AI Day on May 14th. That sounds crucial.
Definitely one to watch if you're following the company.
Absolutely. So if you want to stay plugged into developments like that and get more analysis like this, definitely subscribe to the Stock Analytics AI YouTube channel. And just our standard reminder, this analysis is based on info available as of May 7th, 2025, and we use AI to help synthesize information. It's not financial advice. Always do your own homework and consider your own situation before making investment decisions.
Couldn't agree more. Thanks for diving deep into Upstart with us today. We hope this gives you a lot to think about and encourages you to keep digging.
And we'll leave you with this final thought to chew on. With AI moving so fast and the financial regulations constantly shifting, what do you think is the single biggest hurdle Upstart absolutely has to clear to achieve real, sustainable long-term success? Something to ponder.